Let's talk about something you're very active in, and that is some of the spin-off business, including GE Vernova, one that we know something about. But you've been in quite a few of these. What's going on right now with these companies breaking up and spinning off?
Look, the reality is that more focused companies achieve better results. And the way you get focus is you shrink the mission and you're able to better allocate capital, better incent your employees, have everyone feel as if what they're doing is the main event, that they're mission critical, and more focus does drive greater returns. And when you have these far-flung conglomerates, which really is a throwback to a different era, this notion of diversification, you end up making inefficient capital allocations. The company tends not to benefit from the stars in the portfolio when those assets are in favor because there are other parts of the portfolio that are out of favor. You end up with a less competitive cost of capital, and then you've got shareholders who are frustrated, employees who are frustrated, boards who are frustrated, and increasingly there's a sense that let the shareholders, let them diversify, let them construct their own portfolio, but pure plays are clearly in favor, and they command premium valuations.
So the pure plays are in favor. Is it a fad or is it a permanent structural phenomenon? Because we had in the past times when we want to put together these conglomerates, get them as big as possible, then we broke them up. It feels like it sort of goes back and forth and back and forth. Or are there structural factors that may be pointing in one direction?
Well, look, I would never underestimate Wall Street's ability to come full circle on any issue or any trend. So I hesitate to say we won't see those days again. I think what's different now is you have more vocal share owners who are much more clear in their disdain for companies to just simply create diversification or size without purpose. And I think that probably is a governor that didn't exist a decade ago or 2 decades ago. So you've got much more in-tune boards of directors. You have much more vocal share owners than before. The one cautionary tale to that, David, is if you continue to have a FTC and a DOJ that's going to block horizontal deals and they're going to prevent companies from getting bigger, I suspect that at some point companies are going to it's a natural tendency to look at deals that can get regulatory approval. They may not be the right deals, but I can see if you're frustrated continuously trying to get deals done in your space and you're trying to grow your business, that you then look to diversifying transactions. But my hope is that companies remain focused on the mission.
So start first with the efficient part of the capital markets. How much of this, because the capital markets have become global, they've become much more efficient, so the capital goes to where it belongs, if I can put it that way, much more quickly than they did back, for example, in the 70s or 80s. How much of that is driving some of this splitting up into more focused, perhaps smaller companies?
Look, clearly we're in a world that's speeding up, it's not slowing down, and companies need to have a currency that's competitive. And in many parts of the world, you have companies who are listed outside the United States who enjoy they're burdened by a cost of capital disadvantage. And that's an issue. Then you have here in the United States and elsewhere, conglomerates who are not getting credit for all of the assets that are all housed under one roof. And as they're competing for other assets against pure play companies with a higher flying currency that trades at a higher multiple, they're at a competitive disadvantage. So I think there's a necessity to making sure that you're always front-footed. So what's different now from a generation ago is people are using their currency, companies are using their currency, it's a competitive asset, and you need to make sure it doesn't become a liability. That's driving this. And the second is you have less patient capital today who's not willing to take comfort in the fact that while the stock doesn't trade well, the underlying assets are worth a lot. They want to see the underlying asset values reflected in the share price.
Does it also redound to the shareholders' benefit potentially? I remember talking to Larry Culp that you represented with the GE Vernova spinoff, saying, look, some people want to really back healthcare, some people want to back energy, some people want to back aviation, and when we had them all together, you had to make a choice. Right now, you can go to one or the other, depending on which one you like. Is it actually more power into a lot of shareholders' hands?
It's all of those things. Right now, share owners can diversify themselves. If you own a healthcare stock, and you want to be in aerospace as well, you can buy another pure play company and create your own synthetic conglomerate. That's the first point. So all of this notion of diversification, which was part of financial theory in the 70s and 80s and probably goes back to the 60s, That's been debunked, which is share owners can create their own diversification. Second thing is, when you're in very large organizations that do many things, oftentimes there's not a sense of purpose and an organizing principle for the employees and for the company to have a clear mission. That's different. So I think studies have shown that you get better operating performance. It's not just financial alchemy. You get better operating performance in a focused organization where what you do is mission critical. And I think GE is an incredible success story. Larry Culp and that team have done an extraordinary job. If you look at where they are today versus where they traded, stock is up, I think, 5-fold from the depths for GE. And the combined market capitalization of those three entities is approaching $300 billion. It's extraordinary what they've been able to do, but it starts with operating performance, and then it translates into being able to get that value reflected in the public markets.
You mentioned one of the potential impediments to sort of a more efficient allocation of capital is regulatory potentially, and you mentioned FTC and Department of Justice, but they're not the only ones in the world. I mean, European common market, the EU has its own competition for it. The UK does, China does, Japan does. So are those similarly potential impediments to what you need to get done?
The complexity is multiplying. You know, it's a multiplicative complexity because these are global companies who have global customer bases. They operate almost everywhere in the world. The regulatory approvals they need to come from the EU, the UK, China, the United States. You've got all sorts of different issues, protectionist issues, you've got trade wars, you've got a sense of what's national security issues. You've got the CFIUS issues in the US, you've got consistent concerns elsewhere. And for global companies to be able to navigate all of that, even for those transactions that should be approved and ultimately are approved, it's just taking longer. And that injects more risk. So it can be navigated, and you need to be thoughtful about it. And lots of deals get done. And most deals that get announced do not get successfully challenged. The challenge, though, is you never know whether you're going to be in the crosshairs, whether you're the collateral damage because the regulators aren't really looking at your transaction. They're trying to just send a signal that others in that industry should think twice before they bring transactions to the marketplace. And I think that's one of the ways in which we can explain why in a world that's speeding up, where there's a great desire to constantly grow and develop one's company through acquisitions, divestitures, combinations, why we haven't seen it in the numbers. I think the regulatory oversight from a global perspective has clearly weighed on activity.